Hi everyone, it's my pleasure to talk to you today about historic tax credits. It's what I love to do, and it's probably 80 to 90% of my practice is dealing with historic tax credits, new markets tax credits, state historic tax credits, and then working in some of the energy savings and environmental tax credits that are out there. Today our focus is exclusively on the historic preservation tax credits, primarily the federal. That will be the bulk of the presentation, followed by a brief presentation on state of Ohio tax credits. For those of you that might be located outside the state of Ohio, if you have a question about your particular state tax credits, I've done projects in many states outside of Ohio that have tax credits. I might be able to answer your question or get back to you because I can take a quick look if you have a particular question about perhaps your state tax credit. Starting with this, and again, we're dealing with a very complex topic. This is a basic level, broad brush, trying to give you kind of enough to be dangerous in the area, enough to know maybe where to spot a red flag or ask a question. If you're planning to possibly do a historic tax credit project, please, I urge you to get qualified professional help, because it's just an area where there are mistakes you can make that are unforgivable, can't be corrected, and you could do all the work, do everything in accordance with the Secretary of Interior standards and not get the credit. Or you could get the credit and find out, unfortunately, you cannot use them, and once you placed in service, you cannot transfer it to someone else, so it becomes a loss or stranded credit. So again, we're going to cover the federal historic rehabilitation tax credit and in briefer fashion, the Ohio historic rehabilitation tax credit. And with dealing with Ohio, we're going to build off of what we discussed from the federal, and really can shorten that by showing how it compares and contrasts to the federal. So in general, there are two federal historic rehabilitation tax credits available. The typical one that's used is the 20% credit. It's available when dealing with a certified historic structure. And a structure is certified as historic if it is either individually listed on the National Register or it is a contributor to a National Register historic district. A couple times I've come across buildings that are not individually listing and part of a multi-building listing, but the key thing is the building appears on the National Register or is in a district that is on the National Register of Historic Places. If your building is not a certified structure, and you have to make sure it is not, there is a 10% credit that's available, and it's for structures that were built before 1936. It's a very easy credit from the standpoint of there are no design rules, except you have to maintain 75% of the structure. So you've got a lot of flexibility in dealing with windows and dealing with, you know, pretty much whatever you want to do from a design perspective, but the credit's cut in half. So most projects I've done have been 20% credits. I've only done 10% credits where the building, there was no possible way to get it listed. I've done some that were combined. One building was eligible, one was not. So, but most people, because the credit's twice as big if you have a certified structure, go through whatever steps they can in trying to get a certified structure. The credits are based on qualified rehabilitation expenditures. The shorthand is QREs. If you do a project, you will hear QREs till you're probably sick of the word, but it's really the way we quantify the credits from the standpoint of what expenditures on the projects are available to claim the credit against, and we take that total number of qualified rehab expenditures, multiply it by either the 20% amount or 10% amount, and that's the amount of the credit. The stickling point on the credits is that the credits usually can only be claimed by a non-closely held C corporation. In 2008, there were some amendments to the tax code that do benefit some other unit users, but the question I get more often than not is developers saying, I'm just going to use my credits directly, and probably 9.5 times out of 10 they can't. And it's usually good if I get that call ahead of it being placed in service, I can correct it, and we will find someone who can use the credits and do a syndication of those tax credits so that they get the economic benefit of the credits and don't end up with a stranded credit. And I run through just briefly, and in the slides there's a little more detail, when an individual can use it, and so we'll cover that a little bit later. But primarily, if you're doing a project, you're going to be thinking about selling those credits, and I'm using the word sell loosely. It's syndicating through a partnership structure those credits to a taxpayer, such as a bank and other publicly traded companies who are in the business of buying those credits, and they usually buy them at a discount from face. So if it was 100% tax credit, they might pay you, say, 85 to 90 cents for those credits. And we'll talk through how that works. The typical process, the first thing we do is find out, do we have a certified structure? We go through and check with the National Park Service. We file a Part 1 application. If the building is not already on the National Register, we have to do the same thing. If it's a contributor to the district, it's much simpler to do a Part 1, but you still file a Part 1 to verify, are we dealing with a certified structure or not? One key aspect of it is make sure that you do not finish a project and then place it in service without having a Part 1, because they'll say you have a nullity because you couldn't have had a tax credit project without a Part 1 if you're filing for the 20% credit. So you have to get that Part 1 before you finish or before you place it in service, having somebody move in or occupy it after it's been rehabbed. The Part 2 is the detailed description of your plans and specifications. It gets approved. That's kind of the design review phase of the process with the National Park Service. And the Part 3 is the kind of final wrap-up of the project. You use photographic evidence to prove you did the project and treated the historic elements in the way described in the Part 2. And in the Part 2, you're really only describing the aspects of your project that impact historic features of the building. So it's not every design detail. It's only those design details that impact historic elements of the building. If we're dealing with a non-certified building, and so we're using the 10% credit, you kind of would just go through the process of finding out that you don't have a listed property, and then the rest of this would apply, but you wouldn't do the step with the preservation office. Whether you're a nonprofit or a developer, typically you're going to have a single-purpose entity controlled by whoever the developer is, who's going to own the real estate and develop the project. And typically, we form an entity that owns that particular building so that we're set to create the partnership vehicle to syndicate the tax credit. That tax credit entity needs to own the property, so we have a transfer of the property from the current developer if they already own it, or we make sure that in an acquisition that it's going to the right entity, and that for-profit entity would be the buyer of the property. Generally, it's fee ownership. They actually, there's a transfer of the property by deed. In some cases, long-term leases can be used. Typically, I've done it where I'm dealing with maybe a city-owned property that would be very difficult for the city to transfer, but it's much easier for council to approve a long-term lease. So we've structured it with long-term leases in certain circumstances. You would have your designs by the architect, and sometimes if your architect doesn't have the expertise, bringing in a historic consultant to get your Part 2 and then do your Part 3. please, I typically, unless it's an emergency repair of the roof or some other major structural element, I would recommend not beginning construction before your Part 2 is approved, because I've been involved in a number of projects where the Part 2 was in process, the developer got ahead of it and maybe changed something that, in most cases, we were able to go back and spend some money and undo what they did and change it, but you could actually do something that you think maybe is not a historic element and actually damage the project in a way that they will not certify, and you can't get the tax credit. So construction, you want to be very careful that you follow the Part 2 and have that Part 2 as your roadmap for construction. And it can be very explicit. It may be that, say, brick. In cleaning brick, you have to use the least means possible. So sandblasting is forbidden. High pressure washing is forbidden. So you actually have to document that you cleaned it in an appropriate manner. If you sandblasted, you've now wiped yourself out of being able to claim the credit. So the key thing is they don't want to damage the historic structure in the rehab. You have to make sure that your tax credit investor is in place prior to the property being placed in service. And that, the easy way to think of that is first use. Could be pulling the certificate of occupancy, a temporary certificate of occupancy with somebody moving in, but the property is finished and available for use. And there's some details when we've got phased projects where we might place a portion in service, claim some tax credits, and in the later tax year place additional phases in service. And we'll talk about phasing a little bit in subsequent slides. But the key thing is make sure if you can't use the tax credits directly, we have to find a tax credit investor and syndicate that tax credit before it gets placed in service, because once it's placed in service, that can't be undone. Whoever owned the property, and if it's owned by an entity, whoever owned the entity that owned the property, that's who claims the tax credit on the date, and it's available on the day it's placed in service, and there's no way to undo that. So we're going to step into, what qualifies as a qualified rehabilitation expenditure. It's interior demolition, anything you're doing from the facade of the building in, that would be windows, roof, tuck pointing, all interior construction, and that would include HVAC, plumbing, electrical, pretty much anything you're doing on the interior. Soft costs such as your architect, historic construction consultants, legal fees, construction period interest, and financing fees related to the construction loan, and a developer fee. And we're going to talk a little bit more about developer fees in a subsequent slide, because there's a couple little twists to claiming that. But the developer fee is a fee paid to the developer by the tax credit entity for doing the development. And it's easier to talk about what is not a qualified expenditure, because it is pretty broad. Anything you're doing from within the box of the building qualifies. So what doesn't qualify? Buying land and interest you're paying on the acquisition loan related to land. Building the acquisition of the building itself and paying interest on the acquisition loan. Acquisition related costs, title survey, environmental costs done in connection with the acquisition aren't qualified. If you're doing the environmental in connection with the construction loan, then it's a qualified cost. So it's a question of where the cost, what it was incurred for. If it's incurred in connection with the acquisition, it's not a qualified cost. If it's incurred in connection with the construction loan, it is. And sometimes you have a hybrid where on the acquisition there's a partial acquisition loan, and then part of the loan is the construction, and then we usually allocate those upfront costs by the proportion of the amount of the acquisition versus the amount of the construction loan included. Site improvements, landscaping, parking lots, sidewalks, anything you're doing to the site itself doesn't qualify. Enlargements of the building do not qualify, and I'll talk a little bit more about that, and I have some more in the materials you have discussing the difference between an enlargement and an addition or adding additional floor area within the box. Demolition of volume. So interior demolition counts, but if you take off volume of the building, meaning say if there was a wing of the building that was in poor repair and you were able to convince the SHPO's office that we need to demolish this wing, there's no hope of saving it. Or it may be a more modern wing and you're taking it back to an earlier time period. That demolition cost, the direct cost of that demolition, does not count. Personal property does not count. So if it's movable, non-attached aspects of the project, that doesn't count. And when you have an enlargement, if say the HVAC services both the enlargement and the historic structure, you allocate the volume, or allocate that direct cost, say the HVAC, between the two, the enlargement, which would not qualify, and the historic portion, which would qualify, based on the relative volume of those two spaces. Okay, just quick on developer fees. It's eligible to be a QRE, and what we're typically doing is deferring it, meaning it doesn't get paid at closing, and it gets paid out of future cash flows. And what it does for the developer is typically adds 2.5% to 3% of the total project cost to the bottom line. So that's why it's being done, is it gets more tax credits up front, and then you pay yourself the fee over time. And it's really like taking a portion of the project's cash flows and being able to include that in the qualified cost. You have to make sure that the deferred developer fee agreement is drafted and exists before closing. When we're dealing with related parties, we have to make sure the fee is reasonable. And typically, my view of reasonable, I've used about around usually 15% of the total QREs as the amount of the developer fee. I know some push that to 20. It really, there's no clear guidance, but I've been very comfortable, and most projects I've worked on have used a 15% developer fee. If we defer the fee, we must prove with a reasonable economic model that there's an ability to repay that within 10 years from the project being completed. So that usually is the limiting factor. It's the lesser of 15% or the amount you can repay over a 10-year period. So doing economic modeling of the project and doing that correctly is necessary to prove that the developer fee was reasonable and could be actually included in the project. So that all needs to be done to be able to prove a deferred fee can be included as a qualified cost. But there is great economic benefit to the developer up front for doing that. Just quickly on enlargements. Enlargements, what we're talking about is adding volume to the building. Pretty much you can add additional floors within buildings, create mezzanine space. I mean, there's great freedom to do whatever you need to do within inside the box of the building, and that is considered an addition and is a qualified cost. As soon as you go outside the box of the building, that's when it becomes an enlargement, and those costs are not includable. So there's, it's a little bit more detail, but the quick and dirty is if you add volume to the building, that's an enlargement, not qualified. If you're doing it within the box, it is a qualified cost. Okay, on the slide that we're on, what we're going to talk about, this is the typical structure in the simplest way it can be done of a developer who can't use the credit themselves and needs somebody to pay them for the credit. So what you'll see is we have the developer here, and I'm trying to highlight some. And typically the developer would own somewhere between, 0.01% to 1% of the tax credit entity, and then we're bringing in an investor who can use the credit up here, and they would own somewhere 99 to 99.99% of the tax credit entity. But in this case, the direct investment structure, the tax credit entity directly owns the historic building, and then we would have leases of the historic building to third parties. In some cases, it could be the developer. So, but the primary aspect of qualifying for the credit is we have to have income producing property, and that is why it's very difficult to do a single family home, because it has to be a rental property. If you were doing the single family home and renting it for 5 years, you would qualify for the historic tax credit, and then you could make it your personal residence. Typically, the cost of creating the structure is too expensive for most people to want to do a single family residence unless it's very large in this structure, although I have done it a number of times, and it just, it was very large properties, very large credits, and it more than offset the cost and inconvenience of creating the structure and living 5 years with your primary residence being a rental property. But it can be done. Most investors now want what I'm showing is the leasehold investment structure. Some call it the mezzanine structure, the sandwich lease structure, so it has a number of different names. But the key difference is, what is the entity that is taking the tax credit and what is their interest in the property? And in this case, we're creating a lease. That's the big difference. We're having a leasehold interest be the interest in the property. So we still have the developer, and the developer typically plays two roles here. One is they own 100% of the fee owner entity, meaning this is the entity that directly owns the historic building. And what we do is create a lease to a tax credit entity. So in this case, instead of directly owning the property, the tax credit entity has a leasehold interest, and that's where we bring in the tax credit investor at 99% or better, and the developer at 1% or less of the tax credit entity. The tax credit entity then, is managing the historic building, and the tax credit entity is the one who enters into leases with third parties, or it could be back to the developer. The key reason that investors want to use the leasehold structure is there's just a little bit more tax advantageous structuring for the investor in this and doing it this way. So many, even small, it used to be the small investment funds for small projects would say, oh, we don't care. Now they say they want, it's standard, they want the leasehold model. There still were a few banks that were doing, the direct investment model, but it's becoming less and less common. So that's why I take the time to try to explain the leasehold investment structure. Is you'll see it, you might get a term sheet from somebody that says, requires the leasehold structure, and you at least know, okay, we're doing the more complicated transaction versus the simpler transaction. Does the rehab qualify? The code says you have to have a substantial project, and to do that, or a substantial rehabilitation, and to do that, they look at a 24-month measuring period, and during that 24-month period, and the taxpayer selects when the period starts and ends, you have to spend the greater of $5,000, so that was the minimum project, but no one's doing a $5,000 project, or the adjusted basis of the building as of the beginning of that 24-month period. So the easiest example is a developer buys a building for $100,000, immediately starts rehabbing the building. It takes them 2 years. At the end of that 2-year period, they've done $150,000 worth of qualified costs. That would be a qualified rehab, in that their basis in the building was $100,000. They spent more than $100,000 during the 24-month period, so it's a qualified rehab. If you phase it, meaning the project is broken down into smaller components, that 24-month period becomes 60 months. So if you're doing a project very slowly and have a very high basis, and it's going to take you more time period to reach the point at which you exceed that basis, you can phase the project. You have to describe that up front. What is your phasing? How it's broken down? But you can take a longer time period to spend the money. In some cases, you may want to phase, even though you're meeting that substantial rehab test in a 24-month period, you may want to phase just because you're going to place the project in service in multiple tax years, because it's maybe a 5-story building. You're initially going to do the core in one floor, then do the second and third floor, and finish with the fourth and fifth floor. And that's going to take place over a 3-year tax year period of place in service events. In some cases, you will phase so that each of those tax years you can claim the historic tax credit without being limited, because in the next slide we'll talk about, what amounts are you allowed to include. But the substantial rehab test is just something you have to meet, but it doesn't limit the time period in which you can claim credits, as you'll see in the next slide. Oh, I'm sorry, it's the slide after this, but just in talking, when can the credit be claimed? The great thing about the historic rehab tax credit is 100% of it is available in the year the project is placed in service. And it can be carried back 1 year, carried forward 20 years. But typically, you want to use it from a time value of money perspective in the initial year and the carryback year, so you're getting almost instantaneous value for that credit. Most people are not buying it to carry it forward for 20 years. This is talking about when must the QREs be incurred. It's from the beginning of the rehab project. It will, by definition, include the 24-month period or 60-month period if phased, and it continues through the end of the year the project's placed in service. If you had a project that you didn't phase and is only going to have one placed in service event, you could pick that 24-month period at any point during that 5 years that you meet the substantial rehab test. For example, in the same situation, you buy a building for $100,000, and within the first 24 months, you spend $150,000 putting a new roof on it. You've met the substantial rehab test, even though you're going to continue the project and you work 3 more years completing it and it gets placed in service. You would continue costs from the beginning of the project, include the 24-month period, and you can actually include costs through the end of the year it's placed in service. So if you place in service in September, but you're still finishing details, you can still include costs that are incurred from September through December 31st. So it is a very expansive time period for the federal tax credit. And then because they're giving you 100% of the credit up front, the IRS says, well, for 5 years we want to make sure that you don't do certain things. If you do those certain things, you cause recapture, which means you have to pay back the tax credit. The 3 things that trigger recapture is if you dispose of the property. So that would mean the tax credit entity in a direct investment sells the property, or in a leasehold structure, its lease is terminated. Those are the 2 ways that a disposition of the property occurs. Typically, the developer and the tax credit investor are not going to cause the property to be sold or let the lease be terminated. They're going to protect against that. The typical risk is foreclosure. If you're borrowing money from a third-party bank, that bank, if you don't make payments, may want to foreclose. And that's an area that investors have heightened risk now in the economic downturn. And what you'll see is they're going to push back and say, we want your lender to agree that they will not foreclose on the property or not terminate the lease in a leasehold situation until the end of that 5-year period, and it becomes a stickling point if your lender won't do it. So you may want to consider, as you're going for your construction loan and you're going to use tax credits, getting pre-approval of what's called an SNDA, or Subordination, Non-Disturbance, and Determinant Agreement, that's being requested by your tax credit investor, because that's becoming more and more common. So if you take the risk of foreclosure out of it, most projects will make that 5-year period, and get to the end, the investor goes away happy, they've gotten their tax credits fully earned, and the developer gets its property back. The other way you could cause a recapture is disposing of more than 1/3 of the interest in the tax credit entity. Since your tax credit investor typically owns 99% or more, this is one that's on the tax credit investor. If they transfer the property, their interest, it's their fault, so there's no real risk to the developer there. The noncompliance with the IRS requirements is going outside your Part 2. If your Part 2 said you had to restore and keep the original windows, and sometime during that 5-year period you decide to replace the windows, you've now caused recapture. So it's making sure the project is maintained within what was described in the Part 2 is the other key aspect. And that amount of recapture is 100% during the first 12 months from the date it's placed in service, and it declines 20% every 12 months thereafter. So you're measuring from your placed in service date, or if you include cost after the placed in service date, typically the conservative approach has been we slide that date to the date the last costs were incurred. So even if you placed in service in September but included costs through December 31st, we run that kind of recapture period from December 31st in that case. But at the end of that 5-year period, that's when there's no risk of recapture, and we typically unwind the partnership structure. And why are we using the federal historic tax credit? And I'm using, you can scale this to any size project, but the typical project we're talking about a $5 million project. We're generating a tax credit of $1 million, and the investors are going to pay, somewhere between $800,000 and $900,000 for that credit. So it's real cash to the developer to use to help pay for the construction. After we get to the end of the recapture period, the developer typically buys out the tax credit investor for a nominal sum. What you typically see is a put call, where the put option, that's the investor having the right to force the developer to rebuy or repurchase their interest in the partnership. That's typically priced low. It may be a certain dollar amount. It may be exit taxes. It may be, it depends on the developer. I've seen some as high as 15 to 25% of what they paid for the tax credit. So that's an area that sometimes it's very low. Some investors push that number, to 15 to 20, 25% payback, and you have to analyze that when you're looking at your pricing, not just what they're offering, because they may offer you 98 cents on the dollar up front, but they're going to require you to pay 20, 25% of that number back at the end. So there's typically a pre-negotiated exit strategy, and typically the investor is going to have the call provision, which is your right to force them out, be at fair market value. So you have to be concerned to look at, okay, what is it going to look like at the end of the 5-year period? Is there going to be value? And that's another reason the leasehold structure makes sense, because the terms of the lease can typically strip out most value, so we come up with much lower valuations of the lease versus direct ownership. Why are the investors buying the tax credit? Well, they reduce their tax liability to the federal government. Typically, since they're buying at a discount, their tax department becomes a moneymaker. They increase their bottom line earnings because they have a lower tax payment. If it's a bank, they can meet Community Reinvestment Act obligations. Regardless of whether it's a bank or a private company, they look like a good corporate citizen because they're helping to preserve historic buildings and they're investing in the community. And typically they get favorable press coverage for buying tax credits. Since there is risk of recapture, the investors require the developer provide guarantees. At a minimum, the developer is going to guarantee operating deficits, meaning if the property is running short cash flow, the developer needs to put cash in to keep the project operating. And it's kind of a way of, short of getting to the point where everything's in default, it's saying the developer, if you're $1,000 short on making the mortgage, the developer reaches in their pocket and pays the $1,000 to keep the mortgage current. And the developer is going to guarantee against recapture. And especially after the economic downturn, the investors have gotten very concerned because a lot of investors lost out, and they're going to look at the developer net worth much like banks do and look at things like liquidity. If the developer's net worth is primarily real estate, they're not going to value that as much as they would cash or stock, something that is able to be liquidated. The recapture protection becomes much more important if the bank will not enter into, if you have a mortgage and they will not enter into what we call the super SNDA that protects the investor against the bank foreclosing. If you have that, they're not as concerned about the guarantee because it's less likely that that would happen. If the developer is trying to negotiate contribution earlier than the property being placed in service, they're going to want construction guarantee, lease-up guarantee, and many other guarantees. But it's less likely the investors want to put that money in because they're taking more risk. They're now taking construction risk, cost overrun risk, and so it becomes, they usually discount it more heavily if they have to put their money in earlier, and are going to look much more at the developer's strength, financial strength, because they're taking more risk. Okay, this is just for those of you who are individuals and thinking about, well, maybe I could take the tax credits myself. This is just a little aside to talk about who are those individuals that might be able to take the tax credit. Before 2008, the limiting factor was alt-min tax primarily. It would be, even if you could use it, you couldn't offset alt-minimum tax, so the value of the credit was very small that an individual could use. That was changed so it could be deducted against AMT. Now the limiting factor for individuals is passive activity losses. So there's two types of individuals who could use the credit. One is, since HTCs are considered a passive activity, if the individual has significant passive income, meaning they have income from rent or they're a passive investor in active businesses, if they have significant passive income, you can use that credit to directly offset the passive income. And I've had a couple cases where, you know, somebody happened to own a shopping mall free and clear and had significant passive income, and they were able to use the credits against that passive income. The more typical way I've dealt with individuals using it is where the individual has taken the position on their tax return that they're a real estate professional. If you're a qualified real estate professional, then the tax credit can be applied against all income, regardless of whether it's passive or not. That could be, you know, a real estate developer who has significant income and is active in the trade or business of real estate has been able to use it. Other cases, it may be one spouse is a real estate developer, real estate broker, and the other spouse may be, say, a doctor or, you know, owns their own active trade or business, a company. But in a joint return, they can offset all income. So I've got, typically you need to have somebody who meets the definition of a real estate professional, and that is kind of beyond this scope, but typically it involves at least 750 hours of real estate activity and no other activity being more than 750 hours. So I mean, it's a substantial test to meet. But if you meet it, then you might be able to use the tax credits directly versus syndicating them to another investor. We'll talk about the Ohio issue when we get to the Ohio slides. One other kind of just tips to be wary of is when you're dealing with tax-exempt entities, you have to be very careful in structuring the leases. When you have a nonprofit entity, they cannot claim the credits directly. So if we're dealing with a nonprofit developer, we have to syndicate the credits to be able to get economic value for them. And you have to be very careful in leasing, whether it's the tax-exempt entity that owns the building and is serving as the developer or any other nonprofit. And this could happen to a for-profit developer who leases to nonprofits. You have to still be very careful in your lease structuring. if the nonprofit, who's the developer, owned or occupied the property prior to the rehab being commenced, then that it would be what's called a disqualified lease. So that's what's called a sale leaseback, and just the shorthand term for it. And that means, let's say we have the town hall, and the city offices are there, and the police department is there. So the city is occupying the building. If the city decides to rehab that building and use the tax credits, if any portion that the city uses would be considered a disqualified lease. So typically we have to bring in third parties to lease portions of the structure to make it work. The city can occupy, at the bottom, I talk about note the 50% de minimis rule. If you can have up to 50% of your leases be disqualified leases and still have 100% of the tax credits qualify. Otherwise, you reduce it proportionally. So if you're at 51% disqualified lease, you lose 51% of your tax credits. So the first is the sale leaseback. The other is if you give any nonprofit, whether they own the property, occupied the property prior to the rehab, any nonprofit, a lease term longer than 20 years, you have a disqualified lease. If you give a nonprofit the option to purchase the property, that's a disqualified lease. And if you have a nonprofit who was a participant in issuing tax-exempt bonds for the project, that's a disqualified lease. And then you look at the total of all the disqualified leases you may have in a project, as long as they don't amount to more than 50% of the rentable area within the building, you're still okay. You can still claim 100% of the credits. But if you have tax-exempt entities involved in the transaction, it's even more imperative that you get good counsel to help you through structuring the transaction and your leases. I'm not going to go through all the rest of this. This is probably a little deeper in dealing with tax-exempt entities, and especially when the tax-exempt entity is an owner of the for-profit, or is, I would say, serving as the developer. We're going to now shift to the Ohio rehab tax credit, and just kind of contrast that to what we talked about with the federal rehab credit. Ohio is similar to the federal, and they try to follow, the same rules, the same regulations as to Part 1, Part 2 are sufficient for Ohio. They use the Secretary of Interior standards. They use the same definition of what are qualified rehabilitation expenditures. The Ohio credit is 25% of the qualified rehabilitation expenditures. So it's actually, it's actually higher than the federal, and when you combine the two, you could be looking at 45 cents on the dollar of every dollar of qualified costs you spend coming back to the developer in the form of tax credits. It can be used in combination with the federal historic tax credit. One of the great things about the Ohio program is the credit is refundable, and it does have limits as to how much can be refunded, but for most projects, the developer could get a refund of that tax credit versus selling the tax credit to an investor. The program that has recently been reenacted and been made permanent. It's funded right now at a level of $60 million per year, divided into typically 2 competitive application rounds per year. This year, instead of being $30 million each round, they snuck in a round in the summer that was $20 million. So it was $20 million in the summer, a round that just ended September 30th of $20 million, and then they'll have a round that will open or be March 31st, 2012 at $20 million. So the applications are, the typical is going to be applications due September 30th or March 31st, with an announcement then occurring in end of December for the September round and end of June for the March round. But it's now becoming something that we know is going to be out there. We know the amount it's going to be funded for, so it becomes something that at least developers can plan on it, applying and hopefully being able to get it, but understand it is competitive. To get the Ohio credit is more difficult in that there's an additional application that needs to be prepared and has to be approved by the Ohio Department of Development. If your project already has its Part 2, you've done what is necessary from the standpoint of State Preservation Office, and then the extra step is just filing the application with the Ohio Department of Development. The credits are awarded based on a 100-point scoring criteria. 20 points of that 100 depend upon where your project is located and whether or not that area has received approved Ohio projects. So they give you points off, essentially, if you lose points if you're in Cleveland. Cleveland, right now on the application, you are down to 4 points out of 20 just because so many projects in Cleveland have been approved. Cincinnati is 6 points. That will change for the next round depending on how many projects get approved in Cleveland and Cincinnati, but that was for the most recent application. So you're at a disadvantage if you're in the big cities. If you're in an area that's never had a project, you're instantly up 16 points on a project that is in Cleveland. So I welcome those of you who are kind of in areas that haven't used the state tax credits to look at that. I would make sure you get started probably very soon if you're thinking about it and thinking it through and beginning the process of getting that round 8 application together so it can be filed in March, and not do it in a fire drill. That application will probably come out sometime in January. The major difference in Ohio's structure is that 24-month or 16-month period becomes the limiting factor of when the cost can be incurred. Ohio allows the developer to select the 24-month period that you're going to claim credits, and only costs incurred in that 24-month period are allowable. If you elect the 60-month, you get a longer window, but realize you give up 5 points on the application by phasing. So Ohio is trying to force developers to do the projects quickly, so they're favoring by a 5-point bonus unphased projects over phased projects. And the refundability limit is $3 million, so most projects could get the refund. The issue becomes, most developers forget, state and local tax refunds are taxable for federal purposes. So when you get that refund, as the developer, you've got to pre-plan that the next year you will owe federal tax on those dollars. So in many cases, it may make more sense to syndicate and sell those state tax credits, even though you could get the refund, because the discount that the investor is offering is less than the effective tax rate the taxpayer would be paying or the developer would be paying. So you have to look at that as an additional step to see which is the better decision: take the refund and pay the tax, or sell it because you're getting more net dollars to the project. The one thing I forgot to mention is the Ohio credit is capped at $5 million per project. So what it's stopping is the mega project coming in and taking all 20 million of a round. There still is a bias in the application for larger projects. The larger the building, the more points you get. The points they favor commercial development over residential development and even over retail development. So a office project gets more points than a retail project or a residential project. And they favor projects that are spending dollars that are non-qualified costs, and what they call that is leverage, meaning there are more costs, more investment being made by the developer then is being reimbursed in state tax credits. So the application I think, hopefully is going to stay pretty similar now. I think they've kind of got it down to what is going to be the kind of reoccurring formula. But you can get a copy of that on the Ohio Department of Development websites and kind of look through, and they give you a self-scoring sheet, and you can kind of see what they're giving points for and what they're taking points away for, and kind of get an idea of how successful your project might be. Another difference versus the federal is, for Ohio purposes, the property must already be on the National Register of Historic Places, a contributor to a National Register district, or a local landmark by a certified local government at the time of the application. So the federal Part 1 is a determination that it's eligible for listing, and that gets you the starting point, but a Part 1 that says it's eligible for listing doesn't work for Ohio. You have to actually have the property on the National Register at that point. So it's another step you want to take. I've got a couple clients that we're creating a National Register district. Unfortunately, it didn't get completed and finalized before September 30th. So they'll be waiting and applying for the March round, because that property was ineligible for the Ohio credit because it wasn't a formal, it's on the National Register. It can't be pending. It has to be already on the register at the time of the application. Just realize it's much more competitive. It just takes time, because the federal program is very user-friendly. The developer turns in its Part 1, Part 2. Each of those have if they're complete, a 30-day review at the state, a 30-day review at the federal government, and there's nothing holding up the developer. The developer, can get started really at any time that they choose and complete the project when they want. Because of the lead times, you've got to wait. Now, we've turned in applications September 30th. We've got to sit and wait until December to see if those projects are going to get the state tax credit, and then we can begin the project. So it just realized that there's a longer lead time using the state tax credit. And the amount that you list in your application is the cap. So whatever amount you claim, so if you say we're going to produce $1 million of Ohio state tax credit, that's your cap. If you produce $1.5 million, you're still only going to get $1 million of state tax credit. The federal is based on whatever your actual cost is. And if you have any changes to the project, including the timeline, a transfer of the property, all of that has to be approved by the Ohio Department of Development prior to it happening. So if you're in the middle of the development and you decide this is not a project that you as the developer can get done and want to sell it to another developer, you have to go through the process of transferring this with the state. The federal is much easier. You transfer the property and transfer the application. You don't have to get the approval done ahead of time. So now, I think we're right on time. We tried to leave, half an hour or so for questions. And I know I covered a lot of material very quickly, so hopefully there's a lot of questions we can deal with.
Ron has a question on, if you have a 3-story building on a 1-floor retail, second floor is retail, and the third floor is residential, can you still apply for the tax credit?
Yes. If you're using a certified structure, the whole building could be residential and you could apply for the tax credits. There's no restriction on residential when you're dealing with certified structure. The limitation comes when you're dealing with a non-certified structure and you're using the 10% versus the 20% credit. And in that case, it's a question, as long as 20% or more of the project is non-residential, then it's considered non-residential. So if you had a 5-story building and the first floor is retail, the upper floors are residential, that would be still qualified. If it was exclusively residential, you can't use the 10% credit. But with certified structures, there's no limitation.
Okay, Don and I are going to share the microphone for a second. Apparently there's a little bit of an echo with my phone, so we're going to share the mic. So, Don, the next question is from Corey. If a building was originally 3 stories and the top floor burned and was never replaced, if you want to go through this process and restore the building to its original 3 stories, is this considered an expansion?
Yes, it's a question of what volume exists today, not what was the original volume. As long as you get that approval for adding that extra floor, you can do it, but you can't include the cost of adding that floor. And if you're doing that, you've got to look very carefully at what are direct costs of that addition. So let's just, for example, the direct cost of building the walls, putting the windows in, building the flooring, finishing that space, that would all be non-qualified cost. The roof would then be split based on the volume covered. So if each floor had the same volume, 2/3 of the roof cost would be a qualified cost, 1/3 would not be a qualified cost. The same would go for the HVAC system. If it services all 3 floors, 2/3 qualified, 1/3 not qualified. So it's looking at direct cost versus shared cost and then allocating them based on volume.
And Danny has a question on how can you make historic tax credits work on a smaller certified structure, say in the 3,000 to 10,000 square foot range? Where do you go for professional help for a structure like that?
Those are difficult in that usually the transaction cost will exceed the value of the credit or be very close, and finding the investor is very difficult. Right now it's difficult to find investors even for projects that are spending, you know, $3 or $4 million. Most investors are setting the limit. They want to see $1 million of credit, which is a $5 million project. I have done some smaller structures and helped investors do, or helped developers get those done, usually by capping my fees to maybe 10% of the credit. So I'm doing this at a great discount just to help. And then it's typically finding a friendly investor. The national investors typically won't look at it. Sometimes it may be the bank that is your lender, if you're doing it, might do it. If they're doing the construction loan, they might go ahead and buy the tax credits. I've, in some cases, been able to convince the bank doing the construction loan to buy the tax credits. Or it's looking at, you know, maybe a friend, family member, somebody else who might be able to use them. If, and this is assuming on the smaller structure, the developer themselves can't use the tax credits. On some, it's been in a case where maybe the wife has a very high-paying job, the husband is now kind of full-time doing the real estate development thing, getting them qualified as a real estate professional so then they could use the tax credits themselves over maybe a 1 or 2 year period might make more economic sense. So it's a facts and circumstances thing. I welcome you. Just go ahead, shoot me an email, and if I can help, I'll do what I can.
Thanks, Don. Ron has a second question. What is the normal expense model in applying for a tax credit, and legal costs included in that as well? Oh. What are typical legal fees?
It depends somewhat on the complexity of the project, whether you're combining the state and the federal, if we're syndicating both, if we're using a master lease versus not. But typical would be, you know, 25 to as much as, you know, say 75 to 100 on a pay-as-you-go system, and that I think, and then typically the investor is going to want some accounting done, and that you may have to hire an accounting firm to do projections. So that could add another 12 to 20,000. So I mean, it is an expensive proposition to do it typically, and this is going, and you can shop around and talk to the big firms. There just aren't a lot of folks that do this. So most firms, you know, if you get a fee quote, it's going to be in that range. One thing I do, since I'm my own firm, is working with developers to come up with unique solutions. It may be the developer just can't pay as you go. It would be, you know, I've done contingent fee transactions where I take a percentage of the tax credits at the end. I've done flat fee arrangements. I've done just fee caps, like for smaller projects, just say I'd still like to see small buildings get rehab, so I'll just reduce my legal fees to, you know, 10% of the tax credits and live with that. So creating the flexibility, and I'm also a former CPA, so I do all the financial modeling. This isn't to do a sales pitch, but I'm just saying, shop. You'll find, you know, there's not a lot of people that do this, and most people are at large firms, which I was at and left and went out on my own, and this is what I do. So I'm passionate about it. If you want to talk about, you know, fees, I'm pretty good at coming up with a way to make sure your project gets done and you're still getting net economic benefit for these credits.
Thanks, Don. Mary has two questions. And Mary, I think I'm going to start with your second question first, then I'll get to your first one next. Mary's second question is, how can municipalities best get the ball rolling on a project? If they have an opportunity to get site control through community development block grant acquisition, foreclosure, or donation, but the property is at a start speculative with no national or local registry done, no environmental review, no specific tenant, would it make sense for the city to directly get site control or make sure a third party is granted the funds from the purchase, or to get the purchase? Sorry about that.
Typically, you know, if we're talking about it from a third party, the city could buy it, and there's no real risk of doing that except do the environmental, make sure you're not buying an environmental nightmare. But in some ways, if the city's wanting to incentivize it because the acquisition costs are not qualified costs, one way of helping a private developer is for the city to acquire the building and then maybe sell it to the developer for $1 with restrictions that they have to develop it within a certain time frame and do what the city needs done. But by acquiring that and maybe covering the non-qualified costs, some things I like to go to cities for is sidewalk improvements, parking. You know, the developer, I mean, those are non-qualified costs, having to do that parking. If I can get the city to help with parking, that solves the problem for the project, saves costs for the developer, and the developer can focus its dollars on qualified costs. If the city does not have a historic district, one thing a city can look at is maybe with grant dollars funding a nomination of a district and taking a look at the city and seeing, is there one comprehensive district, are there multiple sub-districts, and getting those districts formed, because that's a big, number one, delay. Forming a district takes way more time than going through, you know, the process of a Part 1, Part 2. But what it does is make many, many more buildings eligible for the tax credit than direct listing. Direct listing is a very high standard, showing it has either national architectural significance, historic significance. It's just a higher standard. Once you've created the district, all we have to show is the building contributes, and especially many buildings have changed over time, and what you're given is much more leniency, is that the building still looks like its neighbors, so it can still contribute, even though it may have had so many changes that it cannot be individually listed. So those are kind of some of the key incentives that the city could do, but always, you know, if it can control the building and kind of control the destiny, it helps, because you can have bad owners that when you have the opportunity to get the building and move it on to somebody who might be a good owner and do the right things with the building, it always helps.
Thanks, Don. And Mary's second question is, has your law firm ever worked with local investment pools before? and individuals that can pool investment?
Are you talking from the standpoint of buying the tax credits, or a pool that is a group trying to just rehab buildings together? Because I've done a number of situations where it may be creating our own, it's maybe 2 or 3 banks or smaller banks, and couldn't any one of them do a project, and I'll pull them together and get them to do a project in, say, rural Kansas where there's no national players looking at. I've done some situations where I've got 2 or 3 individuals that are either real estate professionals or have significant passive income, and kind of create that local pool to do a particular project. And typically it's been outlying areas where we've had no other choice, or where the national players were coming in at such a low number because the project was so small that it just made sense to find a local individual or a group of individuals to buy. And I've created those groups in specific instances. I haven't created what I'll say is a local pool. We've talked about it, and we've got some. It's finding the investors. You got developers who say, boy, we should have a local pool that will buy all our tax credits. But you've got to find those investors that fit the narrow definition and who are able to do it. But having a local pool is really nice, because it would really keep dollars flowing in your community, and you can get a much higher return than going to a national small deal fund that might give you 70 cents on the dollar, and you might be able to get 90 cents on the dollar. In most of the local pools, it's pretty easy to explain to a guy that they're making 10% on their money with little or no risk, and we've been able to put those local kind of private pools together.
Thanks, Don. I'll give you guys a moment just if you have any final questions to type into Don. And in case the echo prevented you from hearing clearly what I had stated before, I'll just rehash 2 of the items. Coming up, there are 3 more tax credit workshops this year that Heritage Ohio is putting on. They're typically 5 hours long. The cost is $30 for members, $35 for non-members. And those are this Friday in Marietta, Ohio, on October 24th in Youngstown, and November 14th in Defiance, Ohio. So if you have any questions, you want to look up more information, you can either go to heritageohio.org or you can call our office. And that number is listed on our website to contact us. The second piece is our upcoming webinar on November 2nd with Angie Hawk-Maiden of AceNet. She's going to be covering how to set up business incubators in your communities, what they are, what steps you should take, why they're important. So that's going to be an interesting webinar coming up. So I'm not seeing any more questions coming in, so I'd just like to turn it over to Don if he has any last comments, and then we'll let you guys go.
I just want to thank you all for taking the time today to find out a little bit about historic tax credits. Realize, just as I said, it's a very complicated area. Definitely, if you're thinking about doing it, get both architects or historic consultants with expertise in the area, and make sure you have legal and tax counsel or accounting help that understand this area, because there are many traps for the unwary. Thanks again, and then all of you have a great day.
Thank you, Don. And once again, we thank Don and the Longwell Legal Firm here. This has been a great asset today. So thank you all for attending, and we hope to see you at our next webinar. Have a good day.